Hello everyone and welcome to my first ever YouTube channel video. My idea of this channel is that I want to explain in a very quick and concise yet comprehensive way everything going on in the stock market here in the United States and also around the world. As many of you may know, this year has been a very intense year for the stock market, and there's a lot to go over. It can be very overwhelming, and there's just a lot of information. And basically what I want to do is any given week go out and do my research, gather all the stock market news I can find and condense it into a quick 10 to 15 minute video just explaining what's going on in the world of finance. This first video might be a little bit longer just because of this introduction and explaining everything, but my goal is just to break down everything going on in just a quick video that you can just sit down and listen to every week. So for this first video, I'm going over this last week, so July 10th to July 16th, and everything that happened in the markets throughout that period. So first of all, here are all the major indexes and major stock market exchanges all around the world. First of all, here in the United States, we have the NASDAQ Composite, which is mainly comprised of tech stocks, which dropped 0.625%. We have the S&P 500, which has dropped only about 0.5% in the last week. And then the Dow Jones Industrial Average actually grew just ever so slightly this last week. Some of the big movers here in the United States was higher than anticipated inflationary readings, but still better than expected retail spending, as well as conflicting economic outlooks from some different financial and banking groups. In other parts of the world, in the UK, their main index was down about 0.5%. This is largely due to increased recession fears due to underwhelming GDP growth and their industrial production data. And then in Asia, we have China with the Shanghai Composite, which was down almost 3.5%. This was largely due to the tech stocks getting hammered in the Chinese exchanges due to renewed government crackdown on Chinese big tech due to a recent data breach, as well as some anti-competitive behavior in Chinese big tech. Then in Japan, down roughly 0.4%. And this is because the Japanese central bank is actually embracing a really easy or dovish monetary policy, which is actually causing their currency, the yen, to drastically weaken against other currencies, such as the US dollar. And then next here is the performance of cryptos and commodities from this last week. So we have Bitcoin, which was down about 2%, but Ethereum, which was up almost 11.5%. This has been a very volatile time for crypto. And year to date, Bitcoin is actually down just over 55%, whereas Ethereum is still down about 64%. In the world of commodities, we have gold and silver, which are both down a fair amount, and oil, which actually dropped all the way from 105 to 97. This is about a 7% drop, and this is actually very important because as oil prices come down, so will gas prices, which will help prevent that financial burden on the average consumer, which would also help prevent a future recession. Next up ahead, we have the macroeconomic factors, everything that's really moving the markets this last week and this last month and this year. First of all, the biggest one is inflation. We actually here in the United States have the highest inflation since the 1980s. We had a surprise inflation reading this last week, which is showing signs of sticky inflation, meaning that the inflation is going to stick around longer than expected. And then going hand in hand with this, there's a tightening of worldwide monetary policy. So central banks, in order to fight inflation, are raising interest rates and being more aggressive in order to combat this. As mentioned before, Japan is really the only central bank not to do this. Here in the United States, we began this year of 2022 with interest rates of only 0.25%, which are already up to 1.75%, and they're expected to rise maybe another percent this next meeting, just in a couple weeks. Another thing that's really affecting the markets right now is surging energy prices. So as we all know, the ongoing conflict between Russia and Ukraine has caused a lot of supply chain disruptions, particularly in oil, since Russia is one of the largest exporters of oil. And then these increases in oil prices are leading to higher cost of goods and also lower consumer disposable income. We have a lot of financial groups right now and banks which are thinking there might be a recession because these raising prices are really taking away disposable income from consumers. Another big thing, as mentioned, is the return of Chinese big tech crackdown. So for a couple months, the Chinese government was actually pretty non-involved and actually let these big tech companies perform pretty freely. And there was actually a really good run in the Chinese stock market. This whole year, the Chinese markets has outperformed the United States stock market. However, this last week, something very unfortunate happened in Alibaba, which is basically the Amazon of China. They have a web service similar to Amazon, and there was actually a huge data breach, and like 1 billion records were taken from some Chinese police agency. And because of this, the Chinese government is now continuing their finding, surveillance, and intervention in Chinese big tech for this reason, but also because of some anti-competitive behavior. And this has largely impacted the Chinese stock market and brought it down quite considerably this last week. A good point of data here is that there's actually been some strong corporate guidance. So each quarter, a company will go out and say how much they expect to make in both revenue and earnings. So their revenue less their costs in any given quarter and every given year. And generally, in downturns like this, there are revisions where the company will say, you know what, because of everything going on in the world, we're actually going to lower our estimates. However, very few companies have done this. Very few companies have revised their earnings estimates. And most of the large companies that have reported their earnings have completely exceeded their earnings expectations. This last week, we had some earnings reports from some different banks. A couple fell short, but most of them actually really exceeded their expectations. Another really good thing here is that we have increased consumer spending and some strong consumer reports that just came out. So we had a report this last week that retail spending is up and discretionary spending, such as travel, is increasing. Both of these are very important because they're signs of a healthy consumer. If consumers are able to go out and travel and go on vacation and spend more money at retail stores and online, that means that they have disposable income because travel is something you take care of after you pay all your bills. So this shows that the consumer is not slowing. And these signs of a healthy consumer have actually led many investment banks to believe that a recession is not imminent. And if there is a recession, that it would be very minor. Because prices are rising, but the consumers are footing the bill. They're not really showing any signs of slowing down. Some notable events that I just slightly touched on. First of all, the retail sales report shows that retail sales rose 1% in June, which actually beat analyst estimates. This report shows that online sales grew at a record pace while brick and mortar sales declined. U.S. stocks largely recovered from last week's losses, and all three indexes, so the S&P, NASDAQ, and Dow Jones, are actually all positive for this month of July so far. We have the CPI, which is the Consumer Price Index, which tracks inflation on part of the consumer, which jumped to 9.1% for June. And this was actually slightly above estimates. We were expecting inflation to come down in June, and it actually continued to increase. The majority of this inflation jump was attributable to food and energy costs due to rising oil prices. Also, as mentioned, there was a large data breach in China, so this is a tough time for Chinese big tech. A really important thing here is the VIX, which is also known as the Fear Index, which generally tracks the fear or confidence investors have in the market, dropped from 28 to 24. This is the lowest the VIX has been since April of this year. And this signifies that investors are becoming more confident in the markets and the market's valuations, which is very good news for the markets. Another point of news, Elon Musk, he officially canceled his plans to purchase Twitter, so that is now off the table. And something very good for oil prices is that President Joe Biden just met with Saudi Arabian royalty to try to find a solution to surging oil prices. And just yesterday, Saudi Arabia declared that they will push for greater oil output to try to reduce costs. So that could be very good for the markets. What to look for this week? First of all, going back to the VIX, whether that volatility index continues to decline or whether it makes its way back up, this will point to the level of confidence investors have in the markets. If the VIX does continue to drop, that would be a strong sign that investors have short to long-term confidence in the markets and that there will be a bounce or maybe even a bottom. So how can we tell if this is a bottom of the stock market crash versus the bottom of the stock market crash? So basically, is this the bottom and it's up from here, or will it still be choppy waters for a while before it's all clear? Some important things to notice to really distinctively tell whether something is a bottom or the bottom is to take a look at the three major indexes. So the Dow Jones, S&P, and NASDAQ. All three of them are at important technical levels, showing support at current levels. So if they can continue to hold current levels this upcoming week, this could signal that there actually is an end to the sell-off, at least in the short term. A huge thing to pay attention to is volume. So large movements in any index or stock with high volume in that index or stock generally signals a change of trend. If the stock market is up on a given day or week, but the volume is low, that generally signifies a bounce. So it's important to look not only at price movements, but volume movements within those prices. Another important thing to look at is a narrative shift in the news with the media, especially surrounding the Federal Reserve meeting. There's going to be a lot of upcoming economic outlook reports by some investment banks, and it's going to be very important to read those and to gauge what the narrative is, whether there is optimism returning to the markets or whether there's still continued pessimism in the media. So it is very important to pay attention that the Federal Reserve meeting is in 2 weeks. So generally, the week leading up to the meeting, there is news from the Fed chairs or just out in the financial markets of what the move will potentially be. And whatever that move is generally gets priced in the weeks prior. So it's important for us to pay attention to the news to see any potential signals from Fed Chair Powell on what the next rate hike will be. This is in just 2 weeks. It's expected to be between 0.5% to 1%, which would bring the federal funds rate here in the United States to about 2.5%, which is actually beyond neutral territory going into aggressive territory. It's been a while since rates have been that high. And then some reports coming up. Not many, but on this Thursday, there's an initial jobless claims report as well as leading economic indicators report. And then every week, along with all the news, I kind of just want to pick a different investment topic and just break it down in a simple way just to help people understand the trends and the terminology. This week I wanted to talk about, which I've talked about a lot in the past slides, is the relationship between inflation, which is arguably the most important factor going on in the markets right now, and monetary policy. So the Federal Reserve right now is caught in a very tough balancing act. So essentially, when COVID first hit, the markets were hit pretty hard. With all of the shutdowns, there was a huge slowdown in the economy, and the economy for the most part was shut down. In order to help this, in order to prevent a recession or a depression, the Federal Reserve had to lower interest rates, so make it easier to obtain money and cheaper to obtain money, and also give out stimulus. And this did help the markets. However, you can't have loose monetary policy forever, because loose monetary policy causes inflation. And that is the balancing act. I mean, as inflation goes up, you have to fight it with rising interest rates, but neither inflation or interest rates are good for the market. So you kind of have to figure out what a good balance would be in order to continue to grow the economy without tipping it into a recession. So at this point in time, inflation is the highest it's been in decades, and the markets are performing very poorly. And the Federal Reserve has to fight this by making it more expensive to borrow money. And that is kind of where we're caught at right now. So beginning of the year, markets actually shrugged off rising inflation, and they reacted negatively to interest rate hikes. So generally, just like they usually do, markets preferred a dovish Fed. The markets historically, at least these last few years, have loved that the Fed has been very loose. But now that the results of that are coming in, which is rising inflation, there's now a push to cull that inflation. So there's actually been an interesting pivot. This was about a month ago, where inflation is now seen as a bigger threat than tighter monetary policy. And now, completely reverse from what the general trend is, the market now reacts positively to a hawkish Fed. Once feared interest rate hikes are now actually praised by the investment community. When they raised the interest rates 0.75% last month, the market acted positively, and it took off the second they announced that. And that's because making monetary policy tighter will lower inflation by, cooling down demand. There's a quote from last month by Fed Chair Powell right after the meeting where he said, "The process of getting inflation down to 2% will also include some pain. But ultimately, the most painful thing would be if we were to fail to deal with it and inflation were to get entrenched." And as I said, the market surprisingly rallied in the wake of this comment. The tightening of monetary policy is now viewed as the lesser evil to inflation. And most investment banks are actually wanting more interest rate hikes to get inflation in check. So kind of where this balancing act divides the community is there's two different perspectives of what can happen by raising these interest rates. There's the bull case, or the positive case, and the bear case, or the negative case. So for the optimistic case, the bull case, people believe that inflation is close to peaking, that a fall in oil prices will bring inflation below estimates and continue to decline. The optimistic investors notice that consumer spending is up, that PE valuations are well below historical averages, and that the fintech bubble is already burst. That this downturn in the markets was largely a re-rating of multiples, and due to peaked inflation, which could happen in the next month, the Fed will have no reason to be overly aggressive to the point of a recession, and just in general, the market has been wildly oversold. There's a lot of value investors that believe that the market is wildly oversold at the moment, and I agree. However, it's important to look at the other side, or the bear case, the pessimistic case, and they believe that supply chain issues will continue to weigh on profit margins, that the Fed may and can overreact to fighting inflation and tip the economy into a recession. If they raise interest rates too rapidly, too fast, it could tip the economy into a slowdown, into a recession. They also fear that inflation can be sticky, meaning that it will stay around, which would lead to stagflation, and that geopolitical tensions can cause more global panic. And then, just to finish up here, let's see. Okay, then one last thing. Each week, just to make it a little bit more fun, I just wanted to add a weekly spotlight of a different stock, a different asset that I have done a lot of research on, and why I think that it would be a good stock in the long term, and kind of just some commentary on what the stock is. This week, I wanted to go over ChargePoint. This has been one of my favorite stocks, especially recently. It's also a very not common name. Not many people know about this stock. But as you can see by that picture, ChargePoint is a company that builds EV, electric vehicle infrastructure. They're actually the leader of EV charging. They own over 18,000 public chargers just in the United States. That means that 95% of public EV chargers in the US are ChargePoint chargers. They provide chargers for individuals, for government, business, and property management companies, such as apartment complexes. Most importantly, this year they've been rapidly growing in Europe, where EV adoption has become even more mainstream than here in the United States. They recently partnered with Goldman Sachs for public charging equipment financing solutions in an effort to continue to grow EV infrastructure rapidly. The reason I love this stock is because I much prefer to invest in the pick and shovel of the EV trade. This basically means investing in the infrastructure rather than in a particular company. So for example, when it comes to EV, Tesla could be the king of EVs. It could be Ford, it could be Rivian, it could be Toyota. Who knows? However, what we all know, what they all have in common, is that they use electricity. So investing in the foundation, or the pick and shovel, is the preferred option, in my opinion, because regardless of who wins, they all need electricity, they all need charging infrastructure, and ChargePoint will provide it. So yeah, regardless of which EV manufacturer dominates the markets, charging companies will benefit. This is a very small cap stock, which means that there's big potential. This is a new and cheap company in a rapidly growing industry, and I don't think anyone really doubts that EVs are the future. The price of a share of ChargePoint stock is currently only half of the current average analyst price target, meaning that there could be a strong uptrend according to analysts. However, this is a very high volatility play, so it should be treated as a long-term play. I'm investing in ChargePoint for the long term, for the next couple decades. And yeah, well, thank you all for listening to my first presentation. Sorry this week was pretty long. I just had to lay out the foundation of what I wanted this channel to be like. But going forward, just 10, maybe 15 minutes a week, just quickly and hopefully in an unbiased way, explaining everything going on in the financial market, so you can understand the different perspectives, so you can understand the different events going on, and so you can make your own proper, educated investment decisions. Is I am not a licensed financial advisor, but I do love reading the news. I am very involved. I am a businessman by heart, and I really enjoy this. So going forward every Sunday, I'll just do my best to put together a quick video explaining everything going on in the markets, and give it to you in the most simple yet comprehensive way possible. So thank you again, and I'll talk to you again next week. Bye.